Most people who get into the Forex market never make money. Not because the market is impossible, but because they start trading before they understand what they're actually participating in. The truth is, successful traders don't begin with indicators, strategies. They begin by understanding how the market works, who moves it, and why price change in the first place. If you're willing to spend the next few minutes building that foundation, you'll already be ahead of most beginners who jump straight into buying and selling without a plan. So before you press your first trade, let's understand the game before you break. What is Forex? Before we can understand how traders make money, we first need to answer a simple question. What exactly is Forex? A short form for foreign exchange is a global market where currencies are bought and sold. Every time one currency is exchanged for another, a Forex transaction takes place. The Forex market exists because governments, businesses, banks, investors, and individuals like me need to exchange currencies for trade, travel, investment, and many other reasons. So as traders, we participate in this market by attempting to profit from changes in the currency values. In simple terms, Forex trading is the process of speculating on whether one currency will be stronger than or weaker than another. But who are the people and institutions creating those price movements every day? To answer that, we need to look at the key participants in the Forex market. So the key participants, we have the brokers, the individuals, we have commercial banks, we have the companies, institutional investors. For example, the central banks. Central banks influence currency value through monetary policy, interest rates, decisions, and interviewment in the Forex exchange. We have the commercial banks, the businesses and corporations, institutional investors, retail traders, individual traders who are us participate in the Forex market through brokers aiming to profit from fluctuations in prices. In currency prices, as you see. We also have the Forex brokers. The Forex brokers provide traders with access to the foreign exchange market. They act as intermediaries, connecting retail traders to liquidity providers, the currency pair. Now that we understand the market itself, let's look at the basic building block of every Forex trade. The currency pairs, we have the Euro USD, the GBP USD, USD JPY, USD CAD. Each pair is very unique according to the way how people trade it and its liquidity. Now we have the major currency pairs, the minor currency pairs, and the exotic pairs. So in the major currency pairs, we have the Euro USD, the GBP USD, USD JPY. But as a trader, I trade the major currency pairs and minor currency pairs. The exotic pairs are not always easy to trade. They actually have a very, very big spread for retail traders to actually manage them. So let's look at what actually causes currency pairs to rise and fall. The answer lies in the forces that drive supply and demand. So what moves the Forex market? We have interest rates. High interest rates attract investors and strengthen the currency. We have inflation. High inflation can reduce a currency's purchasing power. We have the economic news. Reports like NFP, NFP, the GDP, CPI, the PPI can cause high volatility in the market. We have geopolitical events, wars, elections, and global tension create market uncertainty. We have market settlements. Overall market trader model and risk appetite drive currency pairs. The flow can be many traders can drive the market. All this information shows up in one place, the price chart. Learning to read it is one of the first skills every trader develops. You have to understand price charts. They have candlestick charts. They show price action within a specific time period. That is the bullish candle and the bearish candle. Each candle tells a story between the battle of buyers and sellers. We have trending markets. The uptrend with higher highs and higher lows. We have the downtrend with lower highs and higher and lower lows. We have the ranging market. Price moves between and resistance. As traders, we need a way to measure movements in the market. That's where pips come in. What is a pip? A pip, which is a percentage point, is a small standard price movement in a currency. In most pairs, it's 0.0001, and JPY pair is 0.01. Now, for example, in most pairs, moving from 1.1050 to 1.1051, that's 1 pip. And in JPY pairs, moving from 146 to 50, that's 0.50 to 1.21, that's 1 pip. You see, JPY pairs are kind of different. Knowing how far price moves is important, but understanding how much you're trading is just as important. What is a lot size? A lot size is the amount of currency you're trading. We have a standard lot size, micro size, we have the mini lot size, and the nano lot size. Now, a standard lot size, which represents 100,000 units, represents SUP1. And then a mini lot size, which is 0.1, represents 10,000 units. Then we have the micro lot size, which actually represents 1,000 units. Then we have a nano lot size. This lot size actually works in the cent accounts. Most brokers don't have this lot size, but some do have it. Choosing the right lot size helps you manage your risk and protecting your trading account. One of the reasons Forex attracts so many people is leverage, but it also one of the most misunderstood concept in trading. Yeah, we have a vast number of leverages that a trader may set. Now we have a lower leverage, which is 1-to-1 or 1-to-2. Or some brokers have, even some brokers have, others don't have. We have a medium leverage, we have a higher leverage, we even have an unlimited leverage. Now, a leverage allows you to control a larger position with a smaller amount of capital. For example, with a 1-to-100 leverage, $100 can control $1,000 or even 10,000 or even more, but it has its benefits and the risks. Now, for example, the benefits can provide potential profits, but also the risks can provide potential loss. Allows more trading. At the same time, you can lose your capital very, very quickly. Has opportunities, so many opportunities. Leverage should be used carefully and responsibly. But remember, leverage can increase opportunities, but without risk management, it can also increase losses. This is where many beginner traders struggle. Risk management is one of the most important skills in trading. Without proper risk management, every profitable strategy can fail. Now, when we look at risk to reward ratio can help a trader evaluate whether a trade is worth taking. We have a stop loss, which limits your loss on a trade. We have position size, risk a smaller percent of your trading account. Trade, protect your capital. Stay in the game long enough to win. Professional traders focus on protecting capital first and making profits second. So how do traders actually make decisions? That's a very good question. Most traders actually rely on one or a combination of three main types of trading analysis. For trading analysis, we have technical analysis. Technical analysis actually focuses on charts, price action, and market structures. We have a fundamental analysis, which evaluates economic data, interest rates, commercial banks, and news. We have a sentiment analysis, which focuses on market psychology and trading expectations, or understanding market mood, on even traders' positions. Many experienced traders combine all three. Knowing the theory is useful, but what does the actual process of taking a trade look like from start to finish? Successful traders follow a structured process. First, analyze the market, understand the bigger picture, identify a setup, find high probability opportunities, define risk, decide your stop loss, and the position size. Number 4, execute the trade. Enter with clear plan. Number 5, finally, manage the trade. Then lastly, review the outcome and learn the experience. Consistency comes from following the process rather than acting on emotion. At this point, you understand the basics. Now, let's look at all mistakes that prevent many beginner traders from becoming consistently profitable. 1, there is over trading, revenge trading, trying to win back lost money quickly, risking too much, putting too much on one trade, ignoring a stop loss, obviously not a strategy, chasing the market, entering too many trades too late, using excessive leverage, the first way to blow up your account, of course. Finally, let's talk about what Forex trading is really like and what you should expect if you are thinking about taking it serious. Forex trading is not a shortcut to wealth. It's a skill-based profession that requires education, discipline, and risk management. More so, consistent execution over time. So this is where your trading journey begins. You should have a plan of analyzing, planning for the trade that you're going to take, executing and reviewing, as well as improving. So all you have to do is to focus on the process, not the profit. Protect your capital and then the profit will follow. And if you find this guide helpful and you would like to learn more about the financial market, consider subscribing. My goal with this channel is to make sure that trading concepts is simple, practical and easy to understand, especially for beginners. And if you want to continue right now, I've linked a playlist on the screen that will take you through the next stage, through your next journey. I'll see you in the next video. Thanks for watching.